This chapter of financial accounting, we will talk about liabilities. So we start off with current liabilities. So a current liability is something that the company owes, and they normally owe it within 1 year. So within a month or 2 months. And there's all kinds of different liabilities. So here we have a list of them. So accounts payable is number one, by far the most common. Anytime you get a bill as a company, you enter it into your computer system, and the credit is always going to go to accounts payable. We already talked about unearned revenues. If a customer has paid for services that the company has not yet performed, that is also a liability. And then there's all kinds of accruals. So they can have their income tax payable, they can have sales tax payable, they can have salaries and wages payable, and then there's all kinds of payables that go along with salaries and wages. So payroll taxes, health insurance payables, 401k payable. So there can be just all different types of payable accounts that are current and that are set up and that will be paid within a month or a couple months, and then interest payable. So we'll have a variety of those. So a note payable is when it's a little bit longer than the accounts payable. So maybe say you sell equipment and you sell that equipment to a customer and you give them 90 days to pay. So it's going to be a short-term financing need, but you don't just give them the 90 days for free, you're going to charge them interest. So we'll calculate the interest and we'll record that as well. So here we have an example. If the bank lends $100,000 and they sign a 4-month note that matures on January 1st. So we'll do the different entries that are related to that note. So the first one is just setting it up itself. So we receive the cash. The Cole Williams company receives the cash from the bank. So we debit cash, it comes in, and they create a short-term liability called notes payable by crediting that. Then we're going to adjust for interest. So if we got this loan on September 1st, we would have September, October, November, and December. We would have 4 months worth of interest. So they don't show us the computation for that, but if you would take $100,000 times 12% times 4 divided by 12, because 4 over 12 would be my time, that's going to be $4,000. So it's always your principal times your rate times your time, and in this case it'd be 4 over 12. So then we have interest expense of $4,000, set up an interest payable of $4,000, and then when we go to pay it off, we're going to release the liability, pay that liability off, so we debit that. We're going to pay the interest that we owe, the $4,000, and then we credit the cash for $104,000. So then that's the complete cycle of that note. Then our sales tax payable. So again, if you are a retailer, you have to charge whatever your county sales tax is, and you collect it at the time of the sale, and then you remit it to the taxing agency, so the local county. And you may do it monthly, you may do it quarterly, you may do it weekly. It depends on how big you are and how much sales tax you have. Now, sometimes it can get a little bit tricky when you have these types of examples. So here we have a grocery store that doesn't have it separately. So we don't know this is the sales and this is the separate tax that was charged. We know that in total, the grocery store had receipts or collected $10,600. But we know that they have 100% of the sales price plus 6% of sales tax, because there's a sales tax rate of 6%. So if we take that $10,600 and we divide it by 106%, which would be 1.06 if we put that into a decimal, that gives us $10,000 in sales. So then we have the cash came in at $10,600, and then here's our split. $10,000 of it was sales revenue, and then $600 was the sales tax, and we put that into a liability called sales tax payable. And here's some other examples of unearned revenues. Again, we had that in a prior chapter, but we could have unearned ticket revenue where airlines sell tickets in advance. They haven't performed the services yet, but they've already collected the cash. You can have magazines that maybe you buy the whole year subscription up front, and that is unearned subscription revenue, or rent revenue, like a hotel maybe you paid in advance, or sometimes even there could be your rental agreement might make you pay in advance, and that would be unearned rent revenue until you actually have that services performed. So here we have an example. This university sells 10,000 season football tickets at $50 a game for its 5-game home schedule. So we have 10,000 tickets at $50 a game, gives us $500,000 of cash, and that all goes into unearned ticket revenue. Then after each game is completed, we're going to recognize that revenue. So we would say, okay, now this is the first game maybe, and we have it's 1/5 of it. So 500,000 divided by 5 gives us 100,000. So that's what's earned. So we take it out of the unearned by debiting that, and then now we record the ticket revenue because we have earned it. Then we get into current liabilities that are just current portions of our long-term debt. So possibly we have a long-term note or a mortgage payable or a loan or something like that where we're going to make payments on it over 5 years, but there's a piece of it that's due in the upcoming year. So there's a piece of that long-term debt that would be current. So with this example, they have a $25,000 5-year note, and it specifies that they have to pay $5,000 each year. So that $5,000 is going to be reported as a current liability. The remaining $20,000 would stay as a long-term liability, and we would do the journal entry to put it into its proper category. And then we would pay it out of that current liability as well. Then we get into payroll and payroll taxes. So again, there can be a lot of different payables in here that relate to these payroll deductions. Those all create different liabilities. But we have salaries and wages expense. Salaries are more of our managers and our supervisors or our VPs, and they get paid the same amount every month or bi-weekly. Wages are normally more the people that work per hour. So they make $12 an hour, and we pay them overtime and that type of thing. So we'll have our gross earnings, our gross pay, and then all these different deductions that come out and leave us with our net pay. So if you've had a job, you've realized, hey, when I calculate my hours, I maybe think I should get a $500 check. Well, it ends up only being a $350 check. And then you say, well, why is that? Because you have to cover all of these different deductions. So you have to pay your share of the FICA taxes, you have to pay your share of federal income tax, your share of state and local income taxes. Maybe you're giving to the United Way, maybe you have health insurance deducted, maybe you have a 401k deducted. So again, could be a variety of different scenarios. So here we have an example. If they have a $100,000 total payroll that they debit their wages and salaries expense, FICA tax, the percentage is 7.65%. That's how much the employee has to pay. And then we'll see later that the employer has to match that. But this would be what the employee paid. So 7.65% times the 100,000 gives us $7,650 into a FICA tax payable. They would have looked up the federal income tax brackets and figured out how much each employee has withheld, and that total goes to the federal income tax payable. Same with the state. And then the net pay goes to the salary and wages payable. Then when we actually pay it out, we debit the salary and wages payable and credit cash. Now the employer, so what I said on that last slide, that was the employee's piece, what was withheld from their paycheck. The employer also pays their share. So they pay the exact same share as the employee. So they also pay 7.65% of the wages in FICA. They will pay federal unemployment tax, which is like 0.008%. It's a very small, it's 0.8%, 0.008 is a decimal. And then their state unemployment taxes, again, that would depend on what industry they're in, but those could be around 2%, something like that. So here we have an entry again, the $100,000 payroll. So then now they have FICA at that 7.65%. the federal unemployment at the 0.008, or the 0.8% or the 0.008 is a decimal, and then their state unemployment tax in this case would be 5.4%, so a little higher than what I said. So again, could be a industry that's full of injuries and accidents, so they have, an industry that is laying off workers, maybe very seasonal, so they have higher unemployment taxes to pay. So you see that all of them join together in one total to go to payroll tax expense, but we segregate each liability to the specific tax that it relates to. Okay, then we get into long-term liabilities. So we have long-term liabilities. Those could be bonds, could be mortgages payable, could just be long-term notes, anything that goes beyond a year. So bonds are a very common one in corporations. It's another way for them to borrow money versus just getting a loan from the bank. And they're always issued in $1,000 increments. So sometimes that's something that you just have to know. It's kind of a something that they don't necessarily will tell you for certain. So you need to know that bonds are issued in $1,000 increments. And it's, again, the corporation's way of borrowing money, so they will pay interest on those bonds, and they will pay back the $1,000 at the end. So here we've got some different type of bonds that they show us. And then the issuing of those bonds, the board of directors, because again, it's going to be a publicly traded company, the board of directors and the stockholders must approve the company's desire to issue those bonds. And they'll be authorized at a total face value and at a stated rate of interest that they pay each year. And then there's a legal document, it's like the contract behind the bond, that gives the bondholder all the details about the bond. You know, when it's due, when interest is going to be paid, is it callable, is it convertible, and we'll talk about some of those terms in a future slide. And like I said, it's $1,000 face value. So they'll have that maturity date. Interest payments, they can be made either semi-annually or annually. It depends on the bond. And again, it's a way for the company to borrow funds to have some long-term capital. Now here's an example of like if you were looking up in the Wall Street Journal or something like that to say, okay, what bonds are out there and what are they selling for? So this says, okay, these are Time Warner Cable bonds, and they are paying 6.75%. They mature in 2039, so again, they've got lots of years left. Their close is at 116.4%. So that close is the quoted price. It never shows you the percent, but again, it's something that they expect you to know that means it's a percent of the face value. So it's closing at 116.4% of the $1,000. And like this example, if it was a quoted price at 97, it would be 97% of the $1,000. So again, you got to kind of know some of that because sometimes it won't always be spelled out. Now, many times we have to compute the present value. And if you took business analysis with algebra here, we did that in our very last chapter. You can use your time value of money keys to do it, to say, okay, well, if I'm now selling if I'm selling the bond in the market and the interest rates have changed, how much could I get? So that's really the key, is this market rate of interest is different than what we issued the bonds at, and then the length of time will also impact what investors are willing to pay today. So if we were really going to compute those, we would use our financial calculator and our time value of money. And so if you can remember back to business analysis with algebra, we'd have our N, which is our time to maturity, or the number of interest payments. The interest rate on the IY is the current market rate for similar bonds. The payment is how much it's paying in annual interest, or it could be semi-annual if that was how it was being paid out. The future value is always $1,000 because it's owed at the maturity value. And then we would compute the present value. Now, if the market rate was the same rate as the coupon or the stated rate, the bonds would sell at $1,000. It's only when the market rate is different than that coupon rate that forces this present value to change. Okay, so then now we get into like, let's actually record some of the transactions of the bonds, knowing that again, we could sell them at a price that's different than the $1,000. So here we have, this is talking about bonds can be convertible. I mentioned that in a prior slide, so we'll kind of go through these one at a time. So if we're issuing a bond at face value, they issued $100,000 of bonds that pay 10% interest, and they're at face value. So the market rate equaled the coupon rate, so everything was fine. So we received the cash and we set up the bonds payable. Then at the end of the year, we're going to record the interest. So we have $100,000 of bonds times 10% gives us $10,000 of interest expense, and we set up an interest payable. And then when it's paid, obviously we're going to debit that interest payable and credit cash. And we have to do this entry here because it's the end of the year and we have to make sure our financial statements are correct. Even though the interest is going to be paid out the very next day, we still put it in that payable so that our financial statements as of December 31st show that liability. Okay, so then now this shows you, okay, now what if there's a change? So with our issued at face value, it was all this pink. So the bond is paying it 10% interest, the market is at 10% interest, the bonds are going to sell for $1,000. What if the market rate of interest is 8%? Well, then everybody's going to want these bonds because they pay 10%. If I have $1,000 to invest, I want to earn more, right? I want a higher rate of interest. So then the bonds are going to sell at a premium. If it's the other way, if all the other bonds in the market are paying 12% and these bonds are making 10%, I don't want to buy these bonds. You know what I mean? These bonds would be like last on my list. So they're going to have to sell at a discount. The price is going to go down to get people to buy them. Okay, so here we have an example of one that sells at a discount. So it's $100,000 bonds. We sold them at 98% of the face value for $98,000. So now our entry, we debit the cash at the $98,000. We credit the bonds payable for $100,000, and then we debit an account called a discount. So it's the discount on bonds payable. And then we'll see that these two accounts are always going to net together to show us what the value of those bonds are. So here they show us that. So on the balance sheet, you'd have your bonds payable less the discount. So this would be our value of the bonds on our balance sheet at that point in time. Okay, then if it goes the other way, if it's now they sell at 102%. So they're selling at a premium. Everybody wants them. They're going to be paying more for them. So then now the premium on our bonds payable is a credit balance. So then our entry is we get the cash, $102,000. We set up the bonds payable at the face value of $100,000. So again, what we need to make this entry balance is a $2,000 credit to our premium on bonds payable. Okay, then as we record our interest, this is, I'm sorry, this was redeeming it. Let me go back. So the interest would be the same though. Obviously it's not in the slides, but we would record the interest again at that 10%, but then we'll have to deal with the premium also. So that's on a different slide. So here we're saying once it's time for the bonds it reaches the 2039 year that they're due and they're mature, the company's going to pay them. So they're going to release the bonds payable at $100,000 and then credit cash and pay out the different bondholders their money. There can be times that the bonds are callable. So the company has the ability to call those bonds in before the due date. And when that happens, there's normally going to be an additional amount that they have to pay the bondholders to get them to cash in. But if the bonds are callable, the bondholder has no choice. They will be cashed in. Okay, but then there could be a gain or loss because again, there could be a different amount of money. Then our next objective is accounting for long-term notes payable. Again, so these could be like a mortgage notes payable where you're pledging an asset as security for that loan. And then normally, like say with a mortgage or like a car payment or something like that, you're setting it up where you're making monthly payments over the life of that loan. And that monthly payment, you're going to have a reduction of principal and then a payment of interest. So again, think back to business analysis with algebra. When we did our time value of money computations, we would compute the monthly payment of a loan. We computed the monthly payment of the mortgage, and then we could amortize it. We could go in and say, okay, well, out of that first payment, how much goes to interest, how much reduces the principal, and what is my balance? So it's a similar type scenario here with these mortgages, and here they show us a kind of a schedule that amortizes it out that way. So if they have a $500,000 20-year mortgage, they're making payments, I guess, annually. Yeah, so these are, because these are large amounts. So annual installment payments of $50,926. The amount of interest that comes out of that is $40,000, and the principal is $10,926. If you remember, again, back to business analysis with algebra, and you wanted to use your calculator, you could put in 20 as your N, 8 as your IY. The 500,000 is our present value. With a loan, there's no future value. It's all paid back at the end, and then compute the payment. And you would get that $50,926. And then if you went into your amortization function on your calculator, again, think back to business analysis with algebra, you could isolate your P1 equal to 1, your P2 equal to 1, and then you would get these same exact numbers. $489,074 is the balance. The principal reduction is $10,926, and then the interest is $40,000. So again, use some of those tools that you learned in business analysis with algebra to kind of make sense of some of these. Okay, then here's the journal entries behind it. So when we very first get the mortgage, we would receive the cash, or again, if we were actually purchasing a property, maybe it'd be, land or building or something like that. And then we set up the mortgage payable. Then at the end of the year, we record our interest expense of the $40,000. We reduce our mortgage payable to bring that balance down, and then we credit the cash for our annual installment payment. Okay, then we get to the final objective, which is analyzing the liabilities on our balance sheet. So our balance sheet's always listed in order of liquidity. So our current liabilities are always first, and then our long-term liabilities will follow that on those financial statements. So here's a partial example. So we have current liabilities, we have notes payable, accounts payable, current portions of the long-term debt, salaries and wages payable, and then we have a total there. Then we come down to our long-term liabilities, and we have our bonds payable less the discount, gives us our book value of the bonds. We have a notes payable, and then we have a long-term lease liability. Okay. Then here's again a full balance sheet with our assets and our liabilities and our stockholders' equity. And then we get into some different ratios. So we'll have a current ratio and the working capital. So working capital is more just a formula. Our current assets minus our current liabilities give us our working capital. And then our current ratio is our current assets divided by our current liabilities. Ideally, you would like this to be a 1, and you'd like this to be positive. You want to have more current assets than you do current liabilities, but every industry can be different. So it's always something to kind of compare back to the industry average. Then we get into some solvency ratios. So we have our debt to assets and our times interest earned. So we take our total liabilities divided by our total assets to get this debt ratio. And again, the higher that number, the more risky the company would be. And then the times interest earned is how many times out of your net or operating income can you pay interest expense. So here they have kind of showing you how you back into their operating income. So they have a net loss, they're adding back their interest expense, and they're adding back their income tax. But if you were really looking at someone's financial statements, a lot of times you can just pull the operating income, which would be that number, and then divide that by your interest expense. And this indicates how many times you can pay your interest out of that net income. And the more, the better. Okay, then this talks about going back to the bonds, and this is in the appendix section of your balance sheet or of your chapter. You want to understand that we amortize those discounts or we amortize those premiums. So we're charging the discount off to expense over the life of the bond. So if we had a $2,000 discount and a 5-year bond, we would amortize $400 at the end of each year. So we would debit interest expense for $400, credit the discount on bonds for $400. And we would do that every year for those 5 years. If it were a premium, it would be the other way. We would debit the premium on bonds payable for $400 and credit the interest expense. So again, you got to look at how we initially record that discount and that premium and then reverse it, because we're trying to slowly take it off of our books over the life of the bond, and then the offset would be to interest expense.